Hey guys, so welcome to the channel. So this is going to be a full-on how to invest in stocks for beginners course. It's going to be a completely free course, pretty long, but if you guys want to learn everything there is about investing and you want a really good grasp on how to analyze a stock, how to set up a brokerage account, as well as my tips and techniques for making the most amount of money you can while investing, then this is the video for you. So let's go over some of the things we're going to go over in this really in-depth course. So the first thing we're going over is what the stock market is. We're also going to talk about what exactly are stocks and how they actually make people money, right? When you buy and you sell them, how you actually make money doing that. We'll also go into the different types of stocks that you can buy because it's not so simple. There are many different types of stocks you can buy, and it's definitely something really important that you should know before you start investing. We'll also go over the easiest way to open up a brokerage account. So we'll be going through a couple of my favorite platforms to use and how you can actually get some free stocks doing that as well. We'll go into the different types of accounts that you can use to buy and invest in stocks. A lot of people think there's only one type of stock account that you can use to buy stocks, but that's not true. There are so many different types, so we'll go over those. We'll go into timing the market, if it's a good thing to do, if it's a bad thing to do. Best ways to do stock research, you guys. People have different ways of analyzing stocks and determining what stocks they want to buy. And there really isn't a completely right way to do it, but I will go into a couple different types of ways that you can do your own stock research. And that brings us to key terms. These are terms that you definitely should know before investing, and they will help you actually evaluate different companies and be able to compare different companies with one another. We'll go into the two top ways to make money with stocks, and then we'll also go into dealing with all the taxes that come with investing, right? Anytime you buy something and sell it and realize a gain, or even when you realize a loss, there are tax implications, and you will want to know these things before you start investing. We'll also go into value versus momentum investing, and we'll also talk about Warren Buffett's principles of investing. Warren Buffett is one of the most prolific investors of our time, and it's really insightful to go over what his principles are when looking for companies to buy and sell. We'll talk about how long you should hold stocks for. It really depends on you and what your whole situation is. We'll go over the importance of investing early. This is super important. You'll see as I show you examples why it makes so much sense to invest as early as you can. So if you guys haven't started investing and you're watching this video right now, that is why I really recommend watch this video all the way through, get a good grasp on investing, and then open up your brokerage account today. Of course, we'll also talk about how much money you should invest. This really depends on your whole financial situation, but there are some rules that you can follow that allow you to invest a good chunk of your money, but not all of your money. And that helps you diversify your holdings and not have all your eggs in one basket. Of course, we'll also talk about how you can do your own due diligence before investing in stocks. This is very important. Anytime you listen to someone say, buy the stock, buy that stock, you have to do your own research before actually buying it because it's your money and you need to ultimately make the final decision of whether or not you want to buy a stock. So I know that's a lot, but these are some of the things we'll cover in this video. And yeah, I'm really excited to present all this information. It's completely free. It doesn't cost any money. I know there are a lot of paid courses out there for investing, but to be honest, like a lot of the things you're gonna be learning, you can do them on your own and you can just learn them from this video right here. So just a little background about myself. I am a real estate broker and I am also a serial entrepreneur running different businesses in all different sorts of industries. I have 7 years of investing experience and I'm also an active investing / personal finance YouTuber. So basically I've been making a lot of content about different companies, my recommendations for some of the top stocks you can buy. And overall, I'm just a really big believer in learning about the fundamentals of investing. When you buy and hold stock for the long term, it's such a great way to build wealth. I think it's something that everyone in the whole world should do. And yeah, I've seen a lot of people get really rich from investing. So that's just why I really want to emphasize how important investing is to anyone. So let's first talk about why you should invest in the stock market ASAP, right? There's a lot of potential to make money in the stock market. Now, since the 1800s, we've seen that the average return on your investment happens to be around 7% per year. And you guys, this is not guaranteed. This is just based on the past. So it doesn't guarantee that this is going to happen in the future. But you know, looking at these types of returns, that's pretty good. That's a lot better than having your money sit in a bank account and not really getting any interest. Now, personally, I do believe that long-term investing is a lot safer. It's not 100% safe, but it certainly is more safe than day trading, than swing trading and all that stuff. And when you're investing your money, you're basically letting your money work for you, right? You can go off and work your 9-to-5 job or whatever job you have and make money doing that. You're trading your time for money. But when you invest, you're actually just letting the fact that you have money make money for you. It's a pretty cool thing, and that's why I would consider it pretty passive income. Another reason why you should invest as soon as possible is because you want to hedge against inflation, right? Each year, inflation tends to run about between 2 to 3%, and that means that your money is losing value over time. So if you want your money to make money, you're gonna need it to grow faster than inflation. So like I mentioned before, versus having your money in a savings account, which is probably not making much money for you at all, investing your money instead, if it gets that average return of 7%, which we have seen historically, that is going to really grow your money. We'll talk about compound interest and compound growth later on, but it's gonna grow a lot faster than if you just sit on your money in a bank account. Stocks aren't the only way that you can make money, right? There's also real estate that you can invest in, and there are tons of other assets that you can invest your money in and actually generate money. So if you guys take a look at the screen on the slide, this is the S&P 500 for the last about 40 years, and you can see the growth on that green line. It's been going up pretty consistently. We do have some big corrections every once in a while. But yeah, you can see that obviously it's grown a lot, and that's just pretty much the whole point of investing. You're putting your money to work and it's growing for you long term. So now, what are the reasons for people to invest? Why do people actually want to invest? Well, obviously you want to make more money, but the number one reason is for retirement. And we see that a lot of people, they don't save enough money for retirement. And then when they retire, they start to run out of money and they run into a lot of problems. So the top reasons that people say that they invest is 64% say it's for retirement, 56% say it's for living comfortably, 53% for feeling financially secure, and then 44% for maximizing their wealth. However, almost half of people say that they don't save enough money, they don't invest enough money, and it's something that they want to do more of. 39% expect to be forced to work beyond retirement age, and that's something you really don't want to do. And crazily enough, 12% of people don't contribute to any retirement fund at all, which when I hear that, it's just, I get scared for them. And I just want everyone to be financially secure, and especially when they are older and it's a little bit harder to work. So what is the stock market? The stock market is a marketplace where buyers and sellers can trade shares in companies. So this is regulated by the SEC, and this is in the United States. And the SEC stands for the Securities and Exchange Commission, right? Their whole job is to protect the public, promote fairness, and maintain efficient markets. The companies that are traded in the stock market are all publicly traded companies. These are companies that outside retail investors can go ahead and buy shares of. And when this happens, the owners of that company are diluting their personal equity in exchange for capital. So instead of raising money through venture capital funds and all that stuff, they can actually go to retail investors. So that's like me and you, people who can buy shares on their computer or on their phone, and they can raise money that way. That's the whole point of the stock market. Now, let me tell you guys about what an IPO is. This stands for Initial Public Offering. And basically what happens here is an investment bank underwrites the IPO and they buy up a ton of the shares. So they're taking the risk, and then they're selling those shares on the market for a fee. And that's basically based on the percentage of share price. So when you have a private company that is not yet publicly traded and they want to actually be listed on the stock exchanges, that's when they're going to do this IPO. And right now there are 13 different exchanges in the US. Some of the big ones are the New York Stock Exchange, NYSE, and the NASDAQ, and that is heavily tech focused. So like I said, the stock market allows individual investors like me and you to buy and sell in a regulated environment. And it's basically like an auction. Let's go over what the definition of a stock is. So basically a stock is a piece of a company. I know it sounds a little bit weird, but it's basically your share of ownership in a corporation, a type of currency that is backed by that company. You have units of stock, and those are called shares, and these corporations are going to issue stock to raise funds to operate their business. So let's say you have company A, they have 20 shares available for their company, and you own 4 of those 20 shares. That means that you're gonna have 20% ownership in this company, and that means that you're gonna have 20% of the profits. Now, that doesn't necessarily mean that you're gonna get paid out 20% of the profits. Some companies are more dividend focused companies and they will pay out a big share of their profits. But for most companies, they're going to, rather than paying those profits out to their investors, they're going to reinvest it into the business. Basically, you're making money because the company does well and then the share price goes up. And the share price is really based on the earnings, the performance, as well as the sentiment in the market. So now let's talk about the different types of stock that there are available. The first is common stock. This is the most common type of stock there is. And it's basically you're having ownership in a company and a right to vote. It also allows you access to dividends, being paid out dividends, and these are variable. These are not guaranteed. Some years you might get a dividend if the company is performing well. Some years if the market is crashing or if that company is just not doing well, they might suspend that dividend. The common stock is what most of you guys are going to be buying in the stock market. I only own common stock and I don't have any preferred stock, which is what we're going to be talking about next. So for preferred stock, these types of shares don't give you any voting rights. They give you a more stable dividend and you actually have a bit of priority. So if there is a bankruptcy, you're going to get paid out first in that case. And it's harder to lose or gain value. So these types of shares are not as volatile as common stock. So like I said, common stock, that is what you and I will be trading. And there are 600,000 or more publicly traded companies in the world right now. We can also categorize stocks based on how big the company is. So you have small cap companies, you have mid cap companies, and you have large cap companies. For small cap companies, I'd say that the market value is normally under $2 billion. For mid cap companies, these are those medium sized companies, the market cap will generally be between $2 to $10 billion. And then for large cap companies, that is when the market cap is going to be $10 billion or more. You can also categorize stocks based on the sector that they're in. So you have tech stocks, you have energy stocks, you have auto stocks, you have medical stocks, all that stuff, right? You can also categorize them by location, so where in the world that company is based from. And also you can categorize different stocks as either growth companies or value companies. And you don't have to just buy shares of individual companies. You can actually purchase shares of ETFs, and that's basically going to be tracking these indexes where you're basically buying a small portion of a bunch of different companies. And very similar thing with mutual funds, it's just like a more diversified holding where you buy one share of something, and then that is basically like investing in a ton of different companies. So really when people are saying to diversify in your stocks, that means you're diversifying across different sectors from different locations and also buying growth as well as value stocks. Now let's talk about risk tolerance. And for investing, there's always going to be a small level of risk involved. So you have your most safe way of, I guess, holding your money, and that's in cash. That's not going to grow. That's going to actually lose value with inflation. Then you have bonds. Bonds are probably the safest way that you can actually sort of invest your money and get a small return. Then you have index funds. So like I said, these are tracking indexes and you're investing in a whole bunch of different companies. And that's why the risk is a bit less than buying individual stocks, which is our next one. This is a bit riskier because if a company goes out of business, then you could lose all your money. I'd say that real estate is a bit more risky than stocks. Generally, it really depends on how you trade stocks, but for long-term investing in stocks, that is generally going to be quite a bit safer than real estate. There are a lot of things that can go wrong in real estate, and yeah, that's why I'd say real estate is a bit more risky than stocks in general. And then even riskier than real estate, I'd say, is trading in cryptocurrencies. We've seen cryptocurrencies really boom in the last year, but it is still very risky. It's still very volatile. And yeah, there are different subcategories of each of these that are more or less risky than others, but I'd say this is the general risk profile of each of these types of investments. So just for fun, I kind of want to take you guys through one of my favorite ETFs. This is the Vanguard S&P 500 ETF called VOO. I own a lot of this ETF. And when you're buying this stock, you're basically buying into the S&P 500. You're investing into the top 500 companies in the US. So for most people that invest in stocks, I'd say that if you want to be safe, if you want to just do long-term investing, then VOO is a really great choice because you're investing, like I said, in those 500 or so companies. And it's basically like investing in the US economy as a whole. With the S&P 500, these companies are historically seen to grow more than like a total stock market index, because instead of investing in, let's say, over 3,000 different companies, this index is only on the top 500 companies. But yeah, I just wanted to show you guys one of these companies that I'm heavily invested in and definitely one to consider if you are investing as well. So let's talk about the different types of brokerage accounts, right? Like I said, there's not only one type of account that you can invest your money in. There's quite a few. We'll start with the taxable account. This is the most standard account. It's the one that most people are going to be starting off with. And with this account, you're going to be paying taxes on any of the gains you make with your stocks. So let's say you buy a stock for $10, you sell it for $2, you're gonna have a $2 taxable gain and you will have to pay taxes on that. With the standard taxable account, you can purchase stocks, you can purchase mutual funds, ETFs, pretty much anything. And within the standard account, you can have a cash account and also a margin account. The cash account is basically letting you buy investments with money that you deposit into the account. So you can take $5,000, put it into that cash account, and then use that cash to purchase different stocks. With the margin account, this lets you actually borrow money from your broker to buy investments. This is a lot riskier. It's something that is more advanced, so I'm not going to be talking about it too much in this video, but just know that you do have that option when trading with a standard taxable account. And there are no limits to how much money you can actually put into a standard taxable account. So yeah, a lot of people are going to be trading with this type of account. You also have retirement accounts, and these are something that a lot of people do, but a lot of people also don't do. And it really boggles my mind because these are tax advantaged. So you have the Roth IRA, you have the traditional IRA, you have the SEP, the solo 401k, the 401k, and a lot more. With these types of accounts, you're actually only paying tax one time. So you're paying basically half the amount of taxes as a standard taxable account. I know it's a little bit confusing, but the money you put into your standard taxable account, it's money that you're paying, that you have paid taxes on already, and then you have to pay taxes again on any of that profit. With a retirement account, you're only paying taxes once. So for example, with a 401k, this is a retirement account that a lot of people have. The money that they put into that account, they aren't paying taxes on it. They're actually reducing their taxable income for that year and hence not paying taxes. However, with that traditional 401k, when you do take out the money later on, you will be taxed on any profits. On the reverse side, you have things like the Roth IRA. This is money that you put in post-tax, so you're not actually reducing your taxable income. But when you go to take out the profits later on, you're not going to be paying any taxes. There are some contribution limits to these types of accounts, so you can't put unlimited funds into them. And there are definitely some withdrawal rules which make these a little bit more complicated. But for most people, they're going to have both a standard taxable account as well as a type of retirement account. And we won't go into too much of these in detail, but you also have your health savings account, you have your 529 savings plan, you have your custodial brokerage account if you're under the age of 18 but still want to invest, and you have robo-advisors, and we'll talk more about those later on, but that's also another great way to invest your money. So let's get into how you can actually start opening up your first standard brokerage account. And this is going to allow you to buy and sell stocks. Now, there are tons of different brokerage platforms that you can use out there. For example, there's Robinhood, there's Webull, there's TD Ameritrade, Fidelity, Charles Schwab, and many more. Now, I will say that for beginners, I will typically recommend using an app-based brokerage because these are extremely easy to use. They have great interfaces, and it allows you to just bust out your phone and trade whenever you want. So it really gets over that hump of having trading being somewhat hard and complicated, and makes it a lot easier, which will increase your chances of investing more money and hence making more money. Now with Robinhood and Webull, you can actually get some free stocks if you open up an account. So I will put a link to those in the description below. And if you do use those links, you will be helping support the channel. So thank you so much in advance. So when you are opening up a standard brokerage account through, let's say, Robinhood or Webull, there is no minimum account balance. So you can literally just open up the account, put in $1 and start trading with that. They're super easy to open, but I will say that you have to be 18 or older to open up an account with these. Now, the alternative to opening up one of those standard brokerage accounts through Robinhood or Webull or whatever is to open up a robo-advisor account. This basically allows you to passively invest without having to buy or sell individual stocks. So one great option for this, you guys, is Wealthfront. They're a fantastic company and really one of the most popular robo-advisors out there. So yeah, for Wealthfront, it's a great option for beginners since you have the PhDs, the really smart people at Wealthfront doing all the work for you. You can actually get $5,000 managed for free when you open up an account using my link in the description below. There is a $500 account minimum, so you will have to invest at least $500, and it's super easy to set up. It takes under 5 minutes to do so, and like the other accounts, you do need to be 18 or older. So now going back to the standard brokerage account, if you guys do want to start opening up an account today, I'll just show you guys sort of what the application process is like. First, you want to go to the links in the description below and then click on them and set up an account and get your free stocks. Basically, what they're going to be asking you is to submit an application, and this is only going to take a few minutes. So they'll be asking for a lot of personal information, so things like your social security number, your address, your name, your date of birth, and some other things. They'll have you set up a username and password, so you'll want to make sure that that is super secure. You might want to turn on two-factor authentication or something like that, and then they'll be verifying your identity using the information that you give them. After that, you'll wait for your application to be approved, And then once that is approved, it should be pretty quick. You can actually start to fund your account, put money into it, and then you can start trading right away. So I'm actually gonna take you guys through Robinhood and just show you the whole platform so you get a good feel of what this platform is like. So I've opened up Robinhood right here. This is my main dashboard. It's gonna show you how much money you have invested. So right now I have about 69,000 in this account. It's gonna show you sort of like what the value of your account has been throughout the day. You can kind of scroll through like that, so it's pretty cool. You can also change this so it's showing you the last week, last month, last 3 months, and so on, right? It's also gonna have your buying power right here. So this is the cash that is in your account, but is not yet actively invested into different stocks, right? So right now I have about $5,000 that I can use to actually purchase stocks. Down here, it's gonna be all your stocks that you have, your whole portfolio in this account. So you can see I have Microsoft, Netflix, Disney, Tesla, a bunch more. And if you want to actually click on one of them, I can click on Microsoft right here. I can show you guys the 1 week value, the 1 month value, last 3 months. It's gonna show you your position, your average cost. So that means that my average cost for Microsoft was $203.84. The market value, the portfolio diversity, and then your total return. Now I can go out of this and I wanna actually show you guys this main screen right here, the browse screen. So this is pretty cool in Robinhood because you can actually look at a bunch of these popular lists of stocks. So let's say I want to look at 100 most popular, right? It's gonna show me 100 of the most popular stocks on Robinhood that people are buying through this app. And yeah, just a cool way to see them. You can sort by symbol, by price, and by the percent change. I could also maybe look at crypto. So if you didn't know, you can buy cryptocurrencies on here as well. This is the list that they have. And yeah, just a bunch of other lists here. And they also have news articles. So if you want to stay up to date with sort of the whole news, the whole market, you can just come here and look at all these articles from a bunch of different publishers. And you can see the top movers for the day. So you can see this company was up 60%, crazy. This company is down 46%, also completely crazy. And yeah, just a great place to sort of get your news on what's happening in the economy and in the stock market. So let's say you want to buy a stock, right? Let's say I want to buy a share of, let's say Microsoft, right? This is always a great company to buy. So I'm going to come to the Microsoft screen right here. I'm going to click trade and I'm going to click buy right here. You can see that I could also have clicked sell if I want to sell some of my shares. That shows me I have about $5,000 available. It's going to ask me the number of shares I want to buy. It's going to tell me the current market price and it's going to tell me the estimated cost. Now, if you guys go up here, you can actually see that you can make market orders. You can actually do a bunch of different other types of orders, such as the limit order, trailing stop order, all this stuff. These are a little bit more complicated. So right now I'm just going to show you guys what it looks like for a market order. Let's say I want to buy one share like that. I'm going to click review and then I'm just going to swipe up to buy that. Now I'm not actually going to buy that right now. So I'm going to go back, but let me show you guys how to do a limit order. And this is a really great way to set a maximum price you want to buy Microsoft for. So let's say I don't want to pay more than, let's say $230, right? So I'm gonna set that $230, I'm gonna click continue, and I'm gonna select what the trading hours are, so we'll just use market hours, continue. I'm gonna say that this order is good for today only until 1 p.m., continue. And then basically what's gonna happen is it's only going to purchase Microsoft if the price hits $230 or lower. If it doesn't, then my order is not going to execute and I won't buy the shares. So this is a bit slower to buy. We'll talk more about this later on, but that's pretty much how you set a limit order in Robinhood. So that gives you a glimpse of what Robinhood is like. I'm also gonna take you guys through Webull. This is another great stock trading app. So this is my Webull account. I can go here and this is basically my main dashboard. It's gonna have my account value here at the top. And I'm gonna be able to change to see the last month, last 3 months, and so on, right? So my current market value is about $58,000. I have a cash balance of $666. So that means that I have $666 I can use to buy stocks right now. And I can come down here and these are some of my positions in this account. So this is where I have some of my more risky stock picks. So let's say I want to click on rocket companies, right? Cool. So this is Rocket Companies. It shows me my profit and loss for this company. So right now I've made about $280 from these shares. I have a market value of $4,300. So I have that much of Rocket stock, and also shows me my past orders. So I bought 190 shares at $21.50 a share on January 29th, 2021. Now, if I want to buy more of this, I can go down here and click buy. So right now it's set as standard as a limit order. So I can set what I want my limit price to be using this. I can set the quantity using this, and time in force, extended hours, all that stuff. If I want to do a market order, a little bit easier, I can just go down here. You'll see I don't need to set a limit price or anything like that. And I'll just select how many shares I want to buy, and I can click the buy button. Same thing if I want to sell, I can do a market sell, or I can do a limit sell as well. Webull also has a watch list where you can put different companies that you're actually watching. And they also have a few cool places where you can see some of the top gainers, some of the top losers for today, some of the most active stocks, best performing industries. They have crypto as well, so you can trade cryptocurrencies on here. You can also go to explore, and it's basically going to have a bunch of these cool things here that you can check out. I don't look at this too much, but yeah. The community tab is also very cool. They have news here. They always have competitions with paper trading and stuff like that. They also have news, so very similar to Robinhood. You can check out a bunch of news about the stock market and the economy here. And yeah, it's a great platform. So yeah, if you guys are interested in either Robinhood or Webull, I'll put those links down below. So outside of using Robinhood and Webull, let's talk about robo-advisors, because this is a really great way for people to invest that a lot of people don't talk about. I know I sort of mentioned it earlier, but I want to give you guys some more details on what robo-advisors actually are and how they can help you make money. So basically, robo-advisors are passive investing platforms that help you invest your money for you. So it's very hands-off. You don't need to be constantly checking your portfolio, buying and selling and doing all that. So it is very automated. And basically, these robo-advisors are using algorithms to help you invest for you. They're really inexpensive, and they are algorithm-based financial advisors that are perfect for people who don't want to spend their time following the market. So people that want to be extremely passive investors and not active traders. They'll generally require a lot less capital to start than, let's say, using a human financial advisor, and the annual fees for a robo-advisor are much less. So they'll generally be between 0.25 to 0.5% per year versus 1% for a human financial advisor. And Wealthfront is my top pick for robo-advisors. It's the one that most people use. So if you guys are looking for a robo-advisor, I highly recommend going with them. I'll have their link in the description below. But basically with Wealthfront, you're investing in low-cost ETFs, right? This is a lot more diversified. It's a lot more safe. And they're basically going to help you build a custom diversified portfolio investments that cater to your needs. And with Wealthfront, you can actually open up a bunch of different accounts. You can open up your standard brokerage account that's taxable. You can open up retirement accounts. You can open up education accounts, all that stuff, right? So you have your Roth, traditional, rollover, SEP IRAs, trust, 529 college savings plans, and cash account. And right now, I think their cash account is paying 0.35% APY, which is a lot better than most online banks. So that's also another option. Now for their annual fee, they charge 0.25%. And if you guys use my link below, you're gonna get your first $5,000 managed for free. And yeah, it's just a really great way to invest. And I'm actually gonna show you guys a screen share of what their accounts look like on your phone. So if you open up Wealthfront, it's gonna show you your main dashboard. It's gonna show your net worth today, and it's also going to show you your net worth at retirement. So this is the projected net worth based on all your assets and all that stuff. So if you scroll down there, it's going to show you your cash accounts. It's also going to show you your investment accounts. And if we click on the personal investment account right there, it's going to show you how much money you have invested with them. Right now you can see in this account, $78,000. It's going to show you your line of credit, your tax loss harvesting, your diversified portfolio. So US stocks, foreign stocks, all that stuff. So yeah, if you click on US stocks, it's going to show you your target allocation, your market value, and what things are in it. So VTI, SCHB. So now let's talk about the different types of trades you have when investing in the stock market. The first one is the market order, the second one is the limit order, and the third is the stop order. With the market order, sort of like I showed you guys on Robinhood and Webull, this is when you're buying or selling at the best available price in the current market. So basically the current price as of right now. It's the fastest way to buy or sell, and it's the most basic way to buy and sell stocks. So essentially, you're buying at the current asking price or you're selling at the bid price. Now, on the other hand, with a limit order, this is when you're buying or selling at a specified price that you get to choose. So let's say you have a stock where the current market price is, let's say $18. If you were to do a market order, if you were to do a market buy, then you'd be buying that stock at $18 right now. If you do want to do a limit order to buy that stock, you'd set a limit order to, let's say, $15. This means that it's only going to execute and purchase those shares at $15. So it'll need to drop to that price for it to execute. The risk with this is that it might not execute because the share price might not drop from $18 to $15. You could, however, set a limit order for, let's say, $17.90. There's a pretty good chance that that is going to execute because it might just drop down 10 cents and then it will execute that order. Now, if you set a sell limit, let's say for $20, that means it's only going to sell that stock not at $18, but at $20. So it has to rise to $20. And the risk with this is that it might not execute as well, right? Like it might not hit $20. It might actually keep dropping down and you would have come out ahead just selling it at that current market price of $18. You also have your stop order. This is a bit more complicated, but this is basically going to help you buy or sell when the price moves past a specified price. So now that we've talked about the different types of orders, let's talk about how you can research stocks. And there are definitely some very important metrics to understand. First, of course, is your price. This is the cost to purchase one share of that company. But that price itself needs some context because you're not going to know how many shares there are in total by just looking at the price. What you need to do is you need to know how many shares there are in total. And what you'll do is you'll multiply the price by the number of shares in total to get the market cap. The next thing you can look at is the 52-week low and high. So this is the lowest price that company hit in the last 52 weeks and the highest price that the company hit in the last 52 weeks. So it just gives you some context as to where the share price is currently. You also have your trading volume. So this is the quantity of shares that are traded during a given period. Now, when you have high volume, this means that a lot of people are trading it right now. And what I recommend doing with this is you want to pair it with the trend of that price. So if the price is going up and lots of people are trading, then there is some upward momentum and you might be able to expect it to keep going up for at least a little bit. If there's a lot of trading volume and the price is going down, then that means that there's downward momentum and that could mean that the price continues trending downward. Another key term is beta, and this is the stock's volatility in relation to the overall market. So basically a beta of under 1 means that the stock is less volatile than the current market, and a beta of over 1 means that it's more volatile. And you have the PE ratio, which stands for price to earnings ratio. What this is it's the price per share divided by the annual earnings per share. And that annual earnings per share, I know it's a little bit confusing, but that is the total earnings divided by the total shares outstanding. So let's go into an example about the PE ratio, right? So let's say you have a company that hit $100,000 in earnings last year, and it's valued at $1 million and it sells for $1 million. This means that the PE ratio is 10 because you take your $1 million, divide by 100K, and that gives you 10. What this does is it allows you to compare this company with other companies based on the price and how much money the business is earning. So let's say you have another company that hits $200,000 in earnings and sells for $1.5 million. If you take 1.5 million divided by 200K, that gives you a PE ratio of 7.5. So for these two companies, even though one of them did more earnings, you can see that the PE ratio for that one is smaller, which means that technically, based on the PE ratio, that 200K earning company is the better deal. The higher this PE ratio, the more future growth is already baked into the price. So we've been seeing a lot of companies that have PE ratios, above 50, even above 100, even close to 1,000. And this means that the valuation of that company is just a lot higher than the annual earnings of that company. I'd say right now, any PE ratio that's under 20 is considered pretty low, and it means that the company is valued pretty much where its book value is at. Another really important metric to understand is the PEG ratio. This is the price to earnings to growth ratio. And to calculate this, you're taking the PE ratio, which we just talked about, and you're dividing it by the growth rate of its earnings for a time period. This is going to help you value a stock while factoring in any expected earnings growth. And it's a more standardized way of comparing companies with different growth projections. Now, with the PEG ratio, the lower, the better. So if you have a PEG ratio of under 1, This means that technically this company could be undervalued, and if the PEG ratio is over 1, that means it's technically overvalued. So an example of a PEG ratio, let's say you have company 1, the current price per share is $10, and the earnings per share this year is $1. However, the earnings per share 1 year ago was 66 cents. So with this, if you do the calculations for the PE ratio, it comes out at 10. Now we need to calculate the earnings growth rate. And what we do is we take the earnings per share this year, so $1, and we divide it by the earnings per share last year, which was 66 cents. If you do that and subtract 1, that gives you 0.52, aka 52%. And then finally, to calculate the PEG ratio, we take the PE ratio, which we calculated, which was 10, and you divide that by 52 and you get 0.19. This is a very low PEG ratio, which means that it could be undervalued. Another important metric to understand is the dividend yield. So this is how much a company pays out in dividends each year compared to its stock price. To calculate this, you're going to take the annual dividends per share and divide that by the share price. And this is going to be expressed as a percentage. Let's say, for example, you have a company and the share price is, let's say, $10, right? If the dividend yield for that company is, let's say, 5%, that means that that company is going to be paying out 50 cents in dividends per year. I'd say that any dividend above 3 or 4% means it's a pretty high dividend stock. Any dividend between, let's say, 1 and 2% means it's a mild dividend stock. And then there are a lot of companies out there that just do not pay dividends. Another great metric to learn is the price to book ratio. And what you do for this is you take the stock price and you divide it by the book value per share. This helps tell us the market valuation of a company, which is usually higher, versus its book value. And the book value is found from the net assets of a company. So basically you're taking your assets minus your debt, and that gives you your book value. If you have a price to book ratio of under 1, that is considered good. And if you have a price to book ratio of over 1, that technically means that it could be overvalued. Another very important metric is your profit margin. And this is your profit per dollar of revenue expressed as a percentage. So let's say you have a company and they have a 20% profit margin, right? This means that for each $1 of sales, that means they are getting a net income of 20 cents. Another thing to know is your return on equity. This is the ROE, and it's basically calculating your return on net assets. It's pretty complicated to actually understand what goes into calculating this, but basically it measures the financial performance of a company. What you're gonna do is you're gonna take the net income and you're gonna divide it by the shareholders' equity. A return on equity of 15% and up is considered good, but it really does depend on the sector. Another very important metric that I always look at is the current ratio. And this is basically the current assets divided by the current liabilities. The current ratio is basically going to measure the short-term liquidity of a company. And what I like to do when evaluating companies is I like to see a current ratio that is above 1. This means that they have more current assets than they have current liabilities. And that means that the company does have enough cash to pay off any debts in the short term. However, if the current ratio is way too high, let's say above 5 or 10, this could mean that maybe they aren't using their assets efficiently. So there should be a good balance, but if this number is under 1, this does mean that they are in sort of a precarious situation where they have more liabilities than they have short-term actual assets. So now that we've gone through all these different types of metrics, I want to actually take you guys through a stock and put these to use. So I have pulled up Apple stock, one of the most popular stocks out there with the highest market caps. And I'm on Yahoo Finance. And if you come here, this is going to show you the current stock price. So what it's trading at. If you wanted to buy Apple right now, it'd be at $123 and about 21 cents. It's always changing because the market is still open right now. Come down here and you can see the 52-week range. So in the last 52 weeks, it's been as low as $53.15, but as high as $145.09. So that just gives you some context as to the current price, right? You can see the volume right here and the average volume. And then you have your market cap. So this is your current price multiplied by all the outstanding shares, and that's $2.069 trillion. So large cap company, absolutely gigantic. You have your beta, so 1.25, meaning it is a little bit more volatile than the market. You have a PE ratio of 33.43. So just based off that number, it is a little bit overvalued if you look at it through a PE ratio standpoint. The earnings per share is $3.69. That means that for each share that you have, they are earning $3.69 per year. The dividend yield is right here, so it's expressed as a percentage, so 0.68%, meaning this is a very small, mild dividend stock. And for each share that you have, you're gonna get 82 cents as a dividend as of right now. If you come here to the chart, you can see in the last year, this is the price movement. So obviously a lot of growth, but a little bit of a correction right there in recent months. And if you come here to statistics, this is where you can see a bunch of the other valuation measures and metrics. Market cap right here. We talked about the PEG ratio. So this is the 5-year expected PEG ratio of 2.76. It is above 1, so technically it is overvalued. You have your price to sales and price to book ratios right here. Price to book ratio is 31.63, which is pretty high. So, it is overvalued. Then we come down here to the profitability. So you have your profit margin as at 21.74%, which is pretty good. You want to compare that to the industry. So this is in the tech industry. So I'm not sure what the average is, but you can do that research if you want. You have your return on equity, which we talked about, the ROE, sitting at 82.09%. So obviously very high, very good. You have your income statement stuff if you want to look into that. You have your balance sheet. You can see that they have total cash of $76.83 billion. And the current ratio, which we did talk about, is 1.16. So just above 1. So that is a good sign, but it's not too high, meaning that they have just about 16% higher current assets as they have current liabilities. And then something I always like doing is coming back to the summary page and coming down here to the financials, to the analyst ratings, as well as the analyst price targets. So you can see that for Apple, these are the financials for the last few years. Here we can see the analyst recommendations. So right now they're rating it as a 2 based on all the different analysts that they have in the system, meaning it is a buy according to these analysts. And you also have the price target. So right now the average analyst price target is $152.06, which is higher than the current price of $123.25. Analysts aren't always correct. It's just good to see what other people are thinking. And yeah, it's something I always look at when analyzing stocks. So now let's talk about timing the market and the question, should you do it or should you not? Basically, I'm going to define timing the market as trying to predict the stock market, aka predicting any gains, predicting any crashes, and using those predictions to influence your buying or selling pattern. Now, I will say that historically, it has been better to buy after a crash than to try and time a market high. So based on past historical data, it's been seen that stocks tend to recover. And this is true for any good company that survives a crash or an economic downturn. If there is a large crash, then that could be a good time to buy. And I will say this, don't sell during any of these small crashes because that is called panic selling, and that means you are going to be losing a lot of money that you don't have to lose. If you focus on the long term and hold as long as you can, this puts you in the most strong position for making money through investing. It's just overall a lot safer, and yeah, so my safe answer is if you time the market, it's going to be bad. Rather, you want to spend more time in the market. And just to elaborate on this, you guys, it's super hard to time the market because you need to be right 2 different times, right? You need to guess the top of the market to sell, and you need to guess the bottom of the market to actually reinvest your money. Doing both of these is extremely hard. That's why I'd say if the market crashes and it's a good company, that could be a good time to buy. That's a lot easier to predict than trying to time both the high points as well as the low points. And if you look at the past historical data, you actually see that most gains are from these rally days, right? There are a few really high performing days each year where the share prices go up a lot. So it's very easy to miss those days. Dollar cost averaging. So this is basically a technique of investing over time. It's basically where you're gradually investing into a company over time instead of investing all your money at once. So this is a great tool for new investors who want to limit their risk exposure if a crash does occur, right? You're not putting all your money into the market or into that company at one time. Rather, you're going to put it in slowly. That way, if somehow the market does crash, then the price is going to be a lot lower. You're going to have a lot more buying power, and it's going to mitigate any risk of buying all at a higher price and seeing the market crash. Historically, since the market generally moves up, it should technically be better to buy all at once. But in volatile markets, dollar cost averaging can be a great strategy. Right now, there is a lot of volatility, so that's why I always recommend dollar cost averaging as a good technique. Now let's talk about appreciation versus dividends. And these are 2 ways for you to make money through investing, but it really is like comparing apples to oranges. So the first way you make money through stocks is through appreciation. And this is what happens when you see a rise in the share price just due to the company performance and the market sentiment. When a stock appreciates, let's say you buy at $10, it appreciates to $12, that's when you see that $2 gain. And if you sell it at that $12, then you see that capital gain through appreciation. So appreciation is not guaranteed. It could go either up or it could go down, but if it does go up, that is when you do make money through appreciation. You can also make money through dividends. So these are paid out quarterly usually, and it's a more recurring income. This happens when companies are paying out a portion of their profits to their investors, so they're basically rewarding you by paying you out a little dividend. What you can do with this dividend is you can actually reinvest it, so use that money, that dividend money, to actually buy more shares, or you can pull it out and just use it for your daily life expenses. Now you might be wondering, how come I can't just buy a stock right before the ex-dividend date, right before that dividend is actually paid out, and then sell that stock right after when I come out ahead? The problem with this is that the stock price actually normally drops exactly by the dividend amount right after. So it's basically a wash. You don't really come out ahead. The great thing is that a lot of stocks, they will appreciate in value and they will also pay out dividends. This is great because you can make money in both ways, but I will say that for companies that pay out dividends, usually their appreciation is a little bit slower. And that's because instead of reinvesting all that money back into the company, they're paying out some of those profits to investors. So usually their growth is a little bit slower. Now, one pro about investing in stocks with no dividend is that you don't get taxed until you sell. Appreciation is not taxed until you actually sell that stock. However, on the other hand, with dividends, if you do get paid out a dividend, no matter if you reinvest that money or you just take it out for your life expenses, this is considered a taxable event and you will need to pay taxes each year for those dividends. Also, if you have companies that pay out super high dividends, this usually means that there is more risk because that dividend could easily go away if the profits for that company aren't good that year. And yeah, I've seen that normally these high dividend companies are usually in the telecommunications sectors. So let's also talk about the tax implications of investing. What actually happens when you sell a stock? So when you sell a stock or any capital asset, you will get taxed if you sell it for more than you actually paid for it, right? That constitutes a capital gain. So when you are determining whether or not you want to sell a stock, you really should consider the tax implications. You will owe some taxes if you made money on it. There are two types of capital gains that you need to be aware of. There's long-term capital gains and there's short-term capital gains. Now with long-term capital gains, this occurs when you sell a stock that you hold for 1 year or longer. So let's say I buy a stock today and then I wait over 1 year to sell it. That is going to be a long-term capital gain, and you're actually probably going to be taxed lower on that than if you hold it for under 1 year. The long-term capital gains rates are 0%, 15%, and 20%, and it depends on your income level. Now with short-term capital gains, this occurs when you're selling before 1 year, and this is taxed as ordinary income. So for a lot of high-earning people out there where your income taxes are super high, then that means that holding your stock for 364 days versus holding your stock for, let's say, 366 days could create huge implications in how much you're paying in taxes. So yeah, like I said, in general, holding for over 1 year is going to result in less taxes when you do sell, and your brokerage will send you a tax document each year with your capital gains or losses. This applies to taxable accounts, you guys. When you're talking about retirement accounts, it's a bit different. It's a lot more complex, but the main point is know that there are taxes when you do sell for a profit. Let's go into a little bit more detail about long-term capital gains. I think this is extremely important and just really shows you why it's important to hold for over 1 year. So in 2021, the capital gains tax rate thresholds are as follows. It's 0% if you make up to $40,400 as a single filer. It's 15% if you make between $40,401 to $445,850. And if you make over $455,850, then it's 20%. I will say that there is a possible 3.8% additional tax on top of this for net investment income for really high earners. And that's going to include earnings like taxable interest, dividends, gains, passive rents, annuities, and royalties. But if you're not single and you're married or you're the head of a household, you can check out the rates for the other income levels. Now for short-term capital gains, these are the tax brackets for single filers in 2021. It is a progressive tax system, so let's say your taxable income is between $0 and $9,950. That means that your marginal tax rate is going to be 10%. This goes all the way up to 37% after you make over $523,600. So you can see if you're a high earner and your marginal tax rate, your tax bracket is very high, then selling stocks that you've held for under a year is going to massively increase the amount of taxes you're paying versus if you could just pay those long-term capital gains instead. And this actually does not include state taxes, so that's in addition to this. So yeah, you can see that there's huge savings. Now this section, we're going to be talking about retirement accounts. And these are so important. These allow you to save so much money on taxes, and Most importantly, they allow you to save money and be prepared for retirement. Everyone in their right mind should take advantage of tax advantage retirement accounts. So let's talk about the Roth IRA. This is an account that pretty much everyone should start off with, especially if you're not making that much money right now and you expect to be making more money later on. So yeah, I'd highly consider looking at the Roth IRA if you are eligible. Basically, with this account, you are paying taxes now and you're avoiding taxes on any future gains. So when you are in retirement, when you're at least 59 and a half years old, this account allows you to pull out gains without paying those taxes. And if you compare this to a normal taxable account, you can see that you're paying half the amount of taxes because you're not being taxed twice. Now, for most people, you're going to be able to contribute up to $6,000 per year. There are other retirement accounts that you can research yourself, but I highly recommend looking at taking advantage of these tax advantaged retirement accounts. Now let's talk about tax loss harvesting. This is a strategy that you can use to offset any capital gains that you make. So with tax loss harvesting, the whole definition is you're basically selling shares at a loss to offset a capital gains tax liability, and usually this is done at the end of the year. So let's say you made a bunch of money selling your shares of a company that did really well for the year, right? You made a lot of money with that. What you could do is you can sell some stocks that you actually lost money on, create a loss, and then use that loss to offset any gains in that year. Then after selling for a loss, you can actually replace them with a similar asset. But I will say that there is this wash sale rule, and it says that you cannot repurchase a stock for 30 days if you claim the loss for tax purposes. So let's go through an example of tax loss harvesting. Let's say you've had stock A for 67 days and you want to sell it. Your total gains so far are $100,000, right? You've made a gain of $100,000 on the stock. This results in $100,000 of short-term capital gains because you sold within 67 days and not over 1 year. So this would be taxed at 37% if you are in the highest income bracket. This means that you're gonna have $37,000 in taxes, not including any applicable state taxes. On the other hand, you have had stock B for 180 days and you are thinking about selling it, right? You've actually lost $50,000 on this stock, which is not good, right? But you can actually use that $50,000 of short-term capital loss and offset that $100,000 of short-term capital gains. So if you take 100,000, subtract 50,000, this leaves you with $50,000 of net short-term capital gains, and that's gonna come in at $18,500 in taxes. That definitely is a whole lot better than paying $37,000 in taxes. So that is a technique that you can use to reduce your taxable income. Now the same thing applies for long-term capital gains. I will say that it has to match, so you can only offset long-term capital gains with long-term capital losses. And it really is a great strategy where you can realize tax savings when you want to sell an asset for profit. Okay, value versus momentum investing. Let's talk about Warren Buffett's principles of investing, right? First one is leaders are important. He really cares about who the CEO is, who the leadership board is, because they have a dramatic impact on the performance of that company. His second principle is he wants to invest with facts and not emotions. Stock trading can be extremely emotional, and when you trade with emotions, a lot of the time you're gonna lose. So that's why Warren Buffett likes to look at the facts only and really not look at any of the emotions. He also wants to invest for the long term, and generally he's not going to sell unless the business changes fundamentally in a bad way. So like I said earlier, investing in the long term, probably a lot safer than investing for the short term. Another thing that Warren Buffett says is that for most people, for like 95% of people, an index fund is best. Most people are gonna make more money just investing in a traditional index fund, such as VOO, like we talked about earlier, versus trying to pick out individual companies, trying to time the market, buying when it's low, trying to sell when it's high and all that stuff. When you buy an index fund and just hold it for a long time, that is how the majority of people are going to come out ahead with investing. Another thing that he really emphasizes is try and buy shares of companies that you are knowledgeable about. Don't buy shares in companies that you literally know nothing about. You don't know their business model, you don't know who's running the company, and yeah, that comes down to the due diligence, right? You need to do your own due diligence before investing in any company, and you really need to know that company before investing. His last principle is when you see a great opportunity, take it. So when something comes up in the market where there might be a company that's undervalued, or investors are for some reason just dumping stock for no good apparent reason, then that could be a good time to actually hop on that opportunity and buy shares. And we've seen this a lot in Warren Buffett's career. He'll actually hop on these opportunities as soon as he sees them. Now let's also talk about value versus momentum investing, right? You have on one hand value investors, These people care about fundamental analysis. They care about all those metrics that we talked about, like PE ratio, price to book ratio, all that stuff. And they are specifically looking for companies that they think are undervalued compared to their intrinsic value. That's why value investors, they'll try and buy companies that are undervalued, hold long term, or until that company becomes overvalued, and then they might sell off part of their portion of shares or sell off all their shares. On the other hand, you have momentum and growth investors. So these are traders that don't really care so much about all the fundamentals of the company. They don't care if a company could be overvalued in a sense. Rather, they are looking at the future potential of that company. So things like PE ratio, PB ratio, they don't matter as much. These investments, they tend to be riskier and a little bit more volatile because, since they are overvalued in a sense, there's much more room for them to go up and down. And these types of investors are generally going to prefer investing in these emerging industries. So right now, it's going to be like EV, it's going to be tech, it's going to be all these sectors that, while they are overvalued, they have seen a lot of high growth in the last year. You don't need to be only one of these, you guys. You can be a mix of them. And for most people, I'd recommend not being one or the other. If you're too much of a value investor, then you might be losing out on a lot of possible growth. And if you're a really big momentum/growth investor, then you could be missing out on those really undervalued companies that will continue to grow for a long time. And you might actually buy some companies that are overvalued right now and lose money in the short term. Now let's talk about the importance of investing earlier. I think this is extremely important. And the number one phenomenon that you need to be aware of is compound growth, compound interest. Right? So let's say you have an initial investment of $6,000 and then you decide to contribute $500 per month for 40 years. Given an estimated interest rate of about 7%, which is what we've seen historically, you can see that the growth of that money shoots up so much compared to if you just put that money in a cash account or a savings account or something like that. So based on this graph right here, the results are in 40 years, you will have $1,287,657.42. Compare that to, let's say, if you put that money in just a cash account, you'd probably have about $246,000. And all that vertical growth is happening in the later years. And what we want to do is we want to shift that vertical growth as early as possible. And that's what investing early does. So let's take a look at the impact of when you start investing. I found this from US News and I thought it was extremely eye-opening. So let's say you have someone, Jack, invests $200 per month starting at age 25. So he contributes a total of $96,000. Then you have Jill, who invests $200 per month starting at age 35. So 10 years after Jack, right? She contributes a total of $72,000. Then you have Joey, who invests $200 per month starting at age 45. So a whole 20 years after Jack. He contributes a total of $48,000. If you look at the growth from when they start investing to the age of 65, you can see how drastically different their portfolio values are. Jack only invested $96,000, right? But now his portfolio is valued at over $500,000. Whereas Joey, on the other side of the spectrum, he invests $48,000, so half of Jack, but he only has a portfolio value of $100,000. You can see just how different that is, and that just really shows you how important it is to start investing early. No matter what age you are, if you haven't started investing, that's why I recommend doing that right now, because you want to shift that graph as far left as possible, and you want to take advantage of as much of that vertical growth as possible. So now, how much money should you guys invest? And these are just my opinions. It really depends on your whole situation, but I'd say that you want to invest the money that you don't need to live. That's why raising your income, you guys, is so important. And that's why the rich get richer, right? They have their set base expenses for their life, and then they have all this extra money that they are going to invest into the markets, into real estate, into other investments. However, you don't want to invest in your money that you actually need to live because, of course, we need to live. So if you're young and you have some excess cash, what I recommend doing is open up an account after watching this video and then just start investing to get the ball rolling. You don't need to put in that much money, $5, $10, $100, $1,000, doesn't really matter. The whole point with this is you want to just get over that hump of investing and start investing as early as you can. This is going to increase your chances of putting more money in the future months and just building up that big portfolio that you want to retire off of. However, I will say that if you're young, there are probably some better things that you can invest in that are going to have a much higher ROI. So these are things like your self-improvement, building a business, and spending money on your education. These things can pay off way higher than investing in stocks. But yeah, it really depends on what your goals are in life and where you currently are at. So whatever you're doing, I'd say set a monthly goal of how much money to invest based on your income. Only you know what's best for you. So look through your finances, think how much extra money do I have each month, and then invest a significant portion of that. If it were me and I were starting out, I would prioritize index funds. These are things that you can buy, just set on the side and not really worry about. I would much rather invest my time and effort into building up my self-improvement, building businesses, and generating more income. And of course, something I've been talking about for a long time is due diligence. Anytime you're investing in a stock, you absolutely need to do your own research, right? So the Securities Act of 1933 made it so that brokerages have to disclose specific information about securities before they can be sold to the public. This is like the first level of due diligence. It's from the brokerage, and it means that there are probably not going to be any phony companies out there in the stock market for you to buy. And then the second level of due diligence comes from your own research as a retail investor. So this can be doing your fundamental analysis, evaluating the core attributes of that company and their assets, performance, financials, all that stuff. It can also be a technical analysis, so you're looking at patterns and trends, finding things that other people aren't seeing. I know I didn't really talk about this, like diving into these charts and graphs, but that's also another way that you can actually do your own due diligence. And yeah, when you have those multiple levels of due diligence, that's when you can make investing a lot more safer. It's still not 100% safe as with any type of investing, but you want to be as safe as you can. So my golden rule is I like to try and invest 1 hour minimum for any company that I do want to invest in. If you want to buy individual companies, it's really important that you know what that company does, you know their financials, you know their leadership, you know their whole game plan, and you're comfortable with that. If you want to invest in index funds or through a robo-advisor, that's when you don't need to do too much research, and it's a lot easier, I'd say. Different stocks are going to work for different people, right? What works for you might not work for someone else, and it really comes down to the risk to reward, your timeline, as well as any opinions you have about that company or that industry. If you guys are looking for some more information about stocks, you can check out The Intelligent Investor by Benjamin Graham. This is a great book that most investors are going to start off with. And you can also check out the Investing Quick Start Guide. This is another beginner's guide to investing that I found really helpful. They're really going to dive into the fundamentals of investing, and they're going to be more detailed than this video because you're just going to have hundreds of pages of text. So now, what are some actionable steps you can take right now? First thing, you guys, go and open up a stock brokerage account and get your free stocks. So use my links below if you want to support the channel. Really appreciate that. And then what you want to do after that is fund your account, put some money into it. Doesn't matter how much it is. You just want to get the ball rolling. You want to do your due diligence before investing in anything. And then you want to buy your first stock. You can buy an ETF, you can buy an individual company, or you can just use a robo-advisor like Wealthfront. And then the education doesn't end there. You want to continually learn about the stock market. You want to stay up to date on news and current events, and that's all going to help you out with your investing. If you guys are interested in potentially using a robo-advisor, you can get your first $5,000 managed for free when you use my link below. All you have to do is answer a few questions to determine your risk score. So you have to do zero research, and then they're going to help you set up your account and choose what types of stocks to invest in. So yeah, thank you guys so much for watching this video. I hope you guys got some value out of it. I know it's super long, so if you stuck with me until the very end, then you are a trooper. And I really hope that you are ready right now to start investing. I talked about how important it is to invest early. So guys, do that right now, and happy trading. Thank you so much for watching. If you guys liked the video, make sure to hit that like button and also subscribe to my channel to see more videos just like this. I make a ton of content about personal finance, investing, and entrepreneurship. Thank you again so much for your time, and I'll see you in the next video. Peace.